All right, welcome to Module 5. We're going to be looking at federal income taxes. You want to make sure you have not only my notes open, but the second half of today's lecture, we're going to be diving into this publication 15T. You're going to want to make sure you have that ready to go, as well as a W-4 form. The W-4 forms have changed within the past year. So if you haven't filled one out in a year or more, then it's going to be somewhat new. Usually you fill this out and it's looked the same for a long, long time. But up in right in 2020, they updated the form quite a bit. All right, so Gwen, we're going to get back to that coming up second half. But let's dive in with some of the items you should already know from the Module 3 and Module 4. What I'd like for you to do is answer these 9 questions. Pause the video, answer them, and see how you do. And then we're going to quickly go through the answers to make sure you are up to speed. These are items that I think you should know and definitely take away from this class. So that's why it's good that when you see it more than once, 2 or 3 times, you really begin to remember it. And then down here is just a review of what to do and how to calculate Social Security wage, what's taxable. So you can fill out this little miniature. What this is your taxable wage for Social Security and taxable wage for Medicare, and then the actual tax, and then the net pay. So fill that out, and then we're going to go through the answers. Go ahead and pause now. All right, let's go through the answers here. Which form is filed quarterly for the FICA and federal withholdings? We did that in Module 4. That was our Form 941. When are the FICA and federal withholdings made? When are those deposits made? Well, it depends on your look-back period. It's either going to be monthly or biweekly. And if you're over that $50,000 mark of taxes collected, you're going to be biweekly. Under $50,000, you're monthly. Those are the 2 primary ones. Definitely got to have memorized the percentages for Social Security and Medicare. We got 6.2 for Social Security and 1.45 for Medicare. It's Social Security that has the cap. And for our class session, it is $142,800. Who pays the FICA taxes? Remember, that is both employee and the employer. Typically, the earliest age to collect Social Security would be 62. The latest age to collect Social Security would be age 70. And the normal age for anybody born after it's about 1960, or is it 65? I can't remember. I think it's 1960. Basically, anybody in this class, with a few exceptions, if you're a little older, that's fine. That's if you didn't know, tuition is free for those that are 60 and older at Ivy Tech. For number 8, the answer there, normal retirement age would be 67. And how is a monthly payment amount determined for Social Security? I should state that in there. How is the monthly payment determined for Social Security? And that's by doing your PIA, your primary insurance amount. Remember, they had like the 3 steps, the 90% of your first $996, and then 32% of the up to a certain amount for the next batch, and then 15% for anything over that $6,000 basically dollar amount. Let's get this spelled right. All right. And then our mini little payroll register, the one we're going to want to look out for here is our employee A, because when you add up their old wages plus their new wages, they're going to go over the cap. So this is what we have here, their wage of 10 grand. Social Security wage, well, their Social Security wage would only be $4,800. I didn't have room to really put it all in on my sheet, so I just put in the taxes. But over here, you would have your amounts. Hopefully you have $4,800. And here you would have the $10,000. And then for Social Security, when you take the $4,800 times 6.2, and this is the $5,000 times 6.2, didn't come anywhere near the cap. So hopefully you had a net pay of the $14,174. And this is the miniature little journal entry that would happen. Of course, there's a lot of items left off. but just from the basic information that we were given about FICA taxes, this is what it would look like. All right, let's get into our new stuff. You see the tax code has expanded greatly back when it was basically first legalized early in the 1900s, because before that it was actually found it was unconstitutional. Back in the 1800s, it was they had the tax out, and it was made to help fund the Civil War. And then it was found to be unconstitutional, and then they had to do an amendment so they could definitely collect tax. Otherwise, you can't hardly run a government. You can see how big the IRS has gotten. The amount of pages in the tax code, it just goes up and up every year. This was just the latest one that I found. All right, federal taxes. We'll go through this at a reasonable pace, but I'm not taking too much time on things that you can just read through, just kind of point out some of the higher level items. So taxes, federal taxes are taken out for everybody and are paid by everybody, except they're not taken out, but they still have to be paid just by the individual. They're not taken out for independent contractors. Independent contractors, as we've discussed, they don't have FICA taxes taken out by the person that's paying them. So think of the somebody that comes and paints your house or puts on a new roof. You pay them just a standard fee, say 10 grand to put on a new roof. Say it was an individual, he has his own company. You don't take out taxes. They pay their own taxes. And so you don't take out federal withholdings in either. Now, one weird little caveat, if you didn't know this, that I thought was interesting back when I bought our first home, was real estate agents. Never really thought about them too much until I was buying a home, and they are actually independent contractors, and they have no taxes withheld. They have to pay all their taxes on their own. It was quite interesting to learn more about the real estate at that point. Statutory employees, there's a few of them listed here. They have FICA taxes taken out, which is nice because then they don't have to pay the employer share. But for whatever reason, federal taxes don't have to be taken out, and they have to pay those on their own. I wouldn't like that. I'd rather it just be taken care of and done. These are the individual, most other employees must withhold federal taxes, including, these are just some of the items. So even if you work for the government, if you work for the IRS or you work for a courthouse or whatever, you still have taxes taken out just like everybody else. Not-for-profit, there's no difference. Yeah, the not-for-profit company, they file their taxes differently. They have a different form. They don't file like a normal corporation, but you as the employee are still treated just like any other employee of a typical corporation. So even though you're an employee of any one of these for-profit businesses, you still have taxes taken out. Now, here are some of the items that are specifically mentioned in the code that are not taxed, things that you can get a benefit for, but for what, just for different reasons, they're not going to be taxed on you. All right, the first one here is de minimis. Basically, it's a benefit that you get from your company, but it's just too small and would be too tedious to account for all the time. So if you go in and you need to make 15 copies of something and you use the copy machine, and usually maybe your work doesn't really care, technically you're getting a benefit, and you would be taxed at maybe $1 per page if that's what it would have cost you in the real, if you would go to your local store and get it. So you would have to add $15 onto your taxable income. Well, that would get to be really tedious and a lot. So that's a really small item. Definitely is not taxed. Other items, even up to using a company cell phone. The company gives you a cell phone, and of course, you're probably not going to have two cell phones for most people. So you use your company cell phone also for private calls after hours. You're not going to be taxed a partial amount for that company cell phone. So there's a couple of items of de minimis that you probably don't even think about, but technically they could have been taxed if they're not specifically listed like they are. These no additional cost services. This is, you have to be in the line of business. So if your company is pretty big and they do different items, then you can only take advantage of the services that you are actually a part of, not one of the other sectors. That doesn't count. But if it doesn't cost the company any extra money, then you can take advantage of the service at no additional taxable rate to you. And the biggest one that I can think of is flight attendants. Flight attendants can take free flights. Typically, the airlines allow them to take free flights within the US and a lot of, even sometimes abroad, as long as they pay a certain taxes or fees. And that would typically be a taxable benefit. Whatever they got for free, and they would take the fair value of that, maybe a $200 plane ticket, and that would have to be added on to their W-2. But this one says we allow that, and you don't have to charge for that additional cost services. Employees can get a discount, and you can read through here on what they're allowed up to and to be tax-free. The reduced tuition cost for education. So an employee of an educational organization can a lot of times, if they're a full-time employee, will get a considerable discount, if not completely the tuition waived. And the employee is allowed to not include that, not only for themselves, but spouses and dependents. So that's a nice perk of working at a college or a university, especially a high priced one, a private university, for example. That's a nice benefit. Now, other people who don't work for a university can still get some educational assistance. It's just theirs is capped. If the employer pays over to $5,250, then any amount over that would be taxable to the employee. But up to the $5,200 that's paid to the wherever that individual is going to increase their education, it is tax-free. I just heard recently that Walmart is offering this. McDonald's has already been doing it for quite some time. Other fast food restaurants have been stepping up as well. But I just saw that Walmart will be giving free tuition. I don't know if it's for a 2-year degree or potentially probably a 2-year degree. And if they went to like Ivy Tech tuition definitely falls under this. So there would be no issue of having it to be taxable. Money you put away into a retirement plan. This is money this is money that the employer puts away into your retirement plan. That isn't taxed definitely at the time that it's put away. It's only taxed when you withdraw it out of your 401k, then it's taxable. If the company that you work for puts money into your medical insurance, that's not taxable. That's a free benefit. That's a great thing. If they put money into your flexible spending or health savings account, not taxable. It's just free money for you to pay on your medical or dependent care bills. You can find all the other benefits here if you click on this link. Here's just a couple examples of some other benefits that would actually still be taxable. Again, all benefits are considered taxable unless they're specifically mentioned. That's one thing to keep in mind. So this is just a few items here. If you get the use of a company car, that's a pretty big item. It has a big expense to it, unlike maybe a cell phone that has a much smaller bill than you would have for a company car. You would have to divide out the time and look at the miles that you spend personally versus on the job, and that would be taxable. If the company happens to pay for a vacation, I don't know too many that do that, especially around here, but if they do, that's taxable. If they pay for you to join any kind of a membership somewhere, that is a taxable benefit. And that's going to be added onto your W-2, and you're going to pay tax on that, especially at the end of the year. All right. So these are specific payments. Our next item here by the employer for your benefit that are exempt. So these are things that you can possibly get money for. If you get an advance, they pay you ahead of time for they foresee because you're going on a trip, you're traveling for the company, and they pay you and they give you some money up front to pay for the expenses. Just because the money is given to you up front doesn't matter. It's not taxed. It would be the same as if they reimburse you afterwards. That wouldn't be taxed either. Reimbursing you for company expenses or for your travel, lodging, and food while you're out. If the employer pays for your dependent care, if they have maybe a sitter on site at your company, you can get up to $5,000 value, and that would be tax-free. Anytime you get money from workman's comp, a lot of people get workman's comp and unemployment confused or mixed up because they're both getting payments for not working. It's just workman's comp is you were hurt on the job, And the great thing about workman's comp is it's not taxed. The money that you get is not taxed. Whereas unemployment, that's where you are no longer working through no fault of your own. You're not sick, you're not hurt. It's just the company had to lay you off. Then you're still getting income. And we're going to talk a lot more about unemployment when we get to module 7. Still getting income, but it is taxed. So workman's comp is when you get hurt, the money's not taxed. So that's nice. Employer parking, so that can be quite expensive per month. That's a freebie for you and free tax purposes as well. If the company pays in life insurance premiums, that's extra money that typically would be taxable, except it's specifically excluded. And if the employer contributes into your retirement account. So these are, we're going to look a little bit more into this in just another page or two, but just a quick little overview. This is how much you can put into, and you can notice how decreased the likelihood that you may appreciate these different ones. This one has a lot more red tape. It's very specific on what you can and can't do. And so the amount is a lot higher of what you and your employer together are allowed to put in. Now, you can't put in all of this 58,000. The employer is going to have to put in most of it because you're capped at 19,500. You can add in an additional 6,500. So you can actually put in up to like 20, let's see, that would be 26,000. If you are 50 and older, you can start putting money away. These go up a little bit every year, about $500 to $1,000. This doesn't here, but these guys go up about 500, and this goes up about 1,000 every year. The simple plans, they're a lot more easier to use. There's not so strict guidelines. So to compensate for that, to make sure it's not being abused, they definitely lower the limit a lot, well, compared to these two. In tax class, we go through this a lot more. I just wanted to kind of just give you a brief overview of how much you can put away into a retirement plan and that not be taxed. All right, here's just a few other things that are non-taxable wages. So things that you have earned that are, for whatever reason, they're not taxed. All right, the first one here is deceased person's wages. So the last paycheck, if an individual happens to pass away while they're still working, doesn't mean if they pass away on the job or not, that doesn't matter. Their last paycheck will not have federal taxes taken out. Just was a benefit given. But the bad thing is Social Security didn't think that was such a wise idea, and they still tax you for that. So you're still taking money out for Social Security purposes for a deceased, just not for federal. Cafeteria plans, these are set up by most bigger companies, and you get to have benefits, and the company gives you benefits instead of maybe giving you cash incentives. And these non-cash incentives to wanting you to work there are considered not taxed. So again, we talked about the company putting money into a life insurance policy for you. The company putting in money to pay for health insurance. That can be quite a hefty amount the company puts in. If the company puts money into a flexible spending, and that can go into medical or dependent care. This is how much you can, actually these are, sorry, I think I said company putting in, but this is when you put money in. If you put money into a health insurance, it's not going to be taxed. It's going to be taken off. Remember on our payroll register, when we put, say, $400 off in those yellow squares for medical insurance premiums, it reduces over here the amount that's actually taxable for federal purposes. That's what this is basically just confirming. Flexible spending does the same thing. You can see the max. This is how much you can actually put into your medical or your dependent daycare, and it be considered not taxed. Now, the bad thing about flexible spending compared to health savings account is the FSA is forfeited. And I was curious a long time ago when I first started this position, I wanted to know, well, what does Ivy Tech do with and what it's pretty normal then, if Ivy Tech does it, is probably done across the board by most other places. Well, what happens to that FSA? Forfeited money, if you don't use it, let's say you put away $2,750, the max, and you only use $2,000. by the end of the cutoff and you lost $750. That's not good. You're never going to get that back. So what that does is basically when Ivy Tech sets up this plan, they set it up through a third party, usually some kind of a bank. And then you get a debit card. It's kind of like a debit card. And that's how you pay for all of your medical bills. You write down the credit card number or the debit card number. And the bank or the company doesn't do that for free for Ivy Tech. They're going to charge Ivy Tech and say, hey, if you're going to have a flexible spending through us, we're charging you this much per employee. So that's any unused money helps defer those costs. That's the main thing that it goes for. You can see the other items that it goes for, but number one would be the biggest. All right, health savings account. It's done exactly the same as a flexible spending, except the big difference is you don't lose the money. It's carried over. So you think, well, why wouldn't everybody get that? Well, the only way you can is if you have a high deductible insurance plan. And to have a high deductible, it has to meet these criteria. Your deductible has to be at least this amount for your different status. And if you do hit those, you can see that the amount that you can put away is a lot higher as well. Up here, you could only put away $2,750. Here, if you have a family, you can put away up to $7,200. I mean, that's a lot of money to put away. But if you think your medical bills are going to be that much, then you definitely would want to do that because all $7,200 would be used to pay medical bills. You wouldn't have to pay any tax on that. All right, we're going to just briefly talk about, I'm not going to get into a lot of detail on these 401k. Again, the limit and how much you're allowed to put into a 401k. What I wanted to talk about a little bit more was this IRA. IRAs are individual retirement accounts. So this 401k is set up through your company and you can put money into it. As you can see, you can put up to that much. The IRA is your own account that you set up outside of your company most of the time. And you're allowed to put in by default $6,000. You can put away up to $7,000 if you're at least 50 years old or older. So you can see this one was the same. They give you an increase. Here, the increase isn't nearly as much, but you're still allowed an increase. This amount only goes up, I would say, on average, maybe about every 5 years. It may go up about $500 every 5 years. So the amount that you can put away isn't extraordinarily high, but it's something. So you could put away $6,000 and then your employer doesn't know you're going to do this. So it's still going to show up as taxable wages on your pay and on your W-2 at the end of the year. But that's where you have to file the 1040. And on the 1040, you can take that $6,000 off as a deduction and therefore lower your taxable income back down. So just like if the employer didn't put it on there. So that's what I'm going through. That's what I talk about here, doing it on your 1040. Now, to participate in an IRA, you can't, not just anybody can do it. You have to meet either one of these two options. You can participate in an IRA if your company does not have a 401k type plan option. As long as they don't have that kind of 401k option, then you're free to contribute and set up an IRA. Doesn't matter how much you make. If they do have a retirement plan that they at least participate in for you on your behalf, it doesn't matter if you do or not. As long as they do, if your AGI is less than 65,000, then you can still put more money aside into a private IRA. If you're over 65,000 but between 66 and 76, then you're kind of in that phase out where you can put some away, not the full 6,000, but a partial. And I'll look at the calculation. I'll show you how to do that here in just a second. Or if you're married, it's almost doubled, but not quite. So it's kind of a small little marriage penalty here. If it was doubled, well, then this number would be up to 152,000, where it's only 125. All right, so I should say, if you're single and your AGI, when you calculate your total income is over 76,000, you can't put away into an IRA if you have a company sponsored plan. And the same goes for the married filing joint at 125 and above. Phase out, how it works is basically you take the top number. If you're in between this, if your AGI that you calculate is in between, like this one is 72 in my example, you take the top number and then you subtract out your amount. And that tells you how much you have left before you hit the top. So 4,000 out of the $10,000 span. So 4 divided by 10 says I'm allowed to take 40% of the full amount. And 40% of the full 6,000 would be 2,400. So this person could only put in 2,400 instead of 6,000. And you would do that no matter if, let's say you were at 67,000. You would take 76 minus 67, which would be 9. So 9 over 10 would be 90%. You could do 90% because you're real close to that phase out amount. So they give you then 90%. You can take 90% of 6,000. So which would be 5,400. The difference then between an IRA and a Roth IRA. You may have heard of the two terms or heard of an IRA, but never heard of a Roth. What a Roth is basically is you're paying taxes now in lieu of, and then getting free money, free earnings later on when you retire. So with a Roth IRA, you get no deduction for any amount you put into a Roth IRA. You can put away 6,000, but you're not going to take that off on your taxes anywhere. The good part is you're going to pay the tax now, but any earnings that you make on that 6,000 that you put away and the actual 6,000, both of them together, when you take it back out when you're 65 and retired, then you don't pay tax on it. So that's the benefit of a Roth. If you can pay the tax now, might as well, because then you can get free earnings later. The max contributions stay the same as a regular IRA, and the phase outs are slightly higher than a regular IRA up here if you have a company. This one, it doesn't matter if you're in a company or not. These are just the phase outs. So I just wanted to give one example here. We got a Josephine who's age 60. That's important because she's going to hit that higher amount, not the 6, but she's going to be at the 7. Does not have a qualified retirement account. As an AGI of 202, how much can she deduct and contribute to either one of these, an IRA or a Roth IRA? So think about that. Let's take about a couple minutes and figure these out, and we'll check your answer. So go ahead and pause right now. Okay, so for the first one, she's not going to be affected by her income at all because the company does not have a qualified retirement account. So she can put away the entire 7,000 and deduct all 7,000 if she puts into an IRA, regular IRA. Now for the Roth, she's in this phase out limit. So again, we go back up to our formula. It's the same type of formula, same calculations. Take the top number, 208, minus the 202. So that's 6,000. And then divide 6,000 by the span, which is 10 again. So 10,000, and that would be 6 over 10 would be 60%. So she would be able to put into the Roth IRA 60% of 7,000, which happens to be 4,200. Of course, you cannot deduct anything when you put it into a Roth IRA. All right, now on this lecture example number 1, I wanted to basically make sure we've got it down to what can be taken out and it's not going to be taxed. So I've given you a whole bunch of numbers here. I want you to go through and determine what would be their taxable earnings for FICA and their taxable earnings for federal withholdings. Note his current earnings are only 40,000, so we're not going to hit any kind of Social Security cap. And then you should be able to determine Jack's net pay based on once you got these. So go ahead and let's see what you get. What's your taxable earnings for FICA and for federal withholdings? Go ahead and pause now. All right, let's look at the answers here. For FICA, we're going to take the 1,500, and yep, you can take out 150 for medical premiums. You cannot take out the 100 for 401k. That's only for the federal down below. $50 taken out for union dues. Nope, can't take that out. Or that's, you can take it out, but it's still taxable. $100 for flexible spending. Yep, you can take that out. $100 for the health savings account. Yep, you can take that out. The employer contributions, that doesn't matter. And then 150 for child support. Still got to take money out of your pocket, but it's still going to be taxable. So FICA, when you just subtract out everything, your FICA, when you multiply by 6.2% for Social Security, you're only going to use $1,150 instead of the full $1,500. For federal withholdings, it's going to be exactly the same, except we're going to add in, or we're going to take away one more 100. So your answer would only be $1,050. And then the net pay, when you subtract out all of their withholdings, all the items that are taken out of their check, and then the taxes, the ones that we specified, I didn't specify state or county on here, so I didn't expect you to do that. If you did, fine. If you did the state, your number would be a little bit lower, but this is what we would have gotten, not putting in any state. All right. Withholding allowances. Now we get to the more complex part of this chapter, or this, not chapter, but module. Withholding allowances, we're going to use, and this is where we'll want to begin to bring up our W-4. If you need a break, this would be a good time to take a break, because we're going to, the rest of this lecture will be kind of the second half, and we're going to calculate how to go through these. And we may just go ahead and I think we'll start fresh. Let's start fresh here, and we'll have two shorter segments here, so you're not so burned out.